Understanding a company's financial records is critical to assessing its health, uncovering risks, and determining its true value. In this video, the third in our Buying a Business series, we're going to take an in-depth look at what to focus on when you're considering buying a business. First, review the revenue trends. Check if sales are increasing, decreasing, or stagnant over the last 3 to 5 years. Look for consistent growth, which indicates a business building a brand, delivering for customers, and growing market share. Stagnant or declining trends may be a cause for concern, and volatile growth patterns could indicate that sales were a one-time success that won't be repeated. Next, assess the business profit margins. Look at the trends in absolute numbers and as a percentage of sales. Concentrate on both the gross margin, which is revenue less cost of goods sold divided by sales, and the operating profit margin, which is operating income divided by sales. Gross margin shows how profitable the product or service delivery is. Operating margin includes the impact of overhead and general costs. So healthy, sustainable margins often signal good pricing and efficient operations. Margins that fluctuate widely or are consistently low, that's something you'll need to investigate further. Can the seller explain why those were unusual and won't be repeated again in the future? Third, examine cash flow. Does the business generate enough cash flow to cover daily expenses, reinvest in growth, and provide a positive return for your ownership, risk, and effort? Strong cash flow keeps a business resilient during tough times. Is there any seasonality in the cash flow over the course of the year? So how will you manage the cash flow of the business or external financing to fund those slower periods? You also want to evaluate debt levels. Is the business carrying a manageable amount of debt, or is it over-leveraged? High debt could be a warning sign of risk. Don't forget inventory turnover. Slow-moving inventory ties up capital unnecessarily, while efficient turnover keeps the business agile and responsive to demand. Also review the accounts receivable. Are customers paying on time, or are there delays? Slow collection should be investigated. Is it due to poor invoicing and collection process, or is the customer group you're purchasing filled with non-payers? A good sales number doesn't mean much if the customer doesn't pay. Due diligence is non-negotiable. Request important documents such as detailed financial statements, tax returns, and bank records from the seller. You want to make sure that the numbers line up between the internal financials, the tax return, and the bank. If there are discrepancies, make sure to call them out to the seller and understand the reason behind them. After you do your initial review of everything, consult a professional accountant or financial advisor. Their expertise can uncover insights you might miss and ensure you're interpreting the numbers correctly. Stay tuned for part 4, where we'll focus on asset sale versus stock sale and its benefits for buyers. Be sure to subscribe to our channel for more expert insights.